What's up, you guys? Welcome to the video. Brandon here. Today we're going to be taking a look at 5 ETFs that I personally believe are poised for a very nice 2019. Now, you guys know me. I'm not one to make short-term predictions in the stock market. I am a long-term investor. However, these ETFs, for the reasons that we'll go over, I do think have potential to do well over 2019. So as always, if you enjoyed the video, give it a thumbs up. And of course, all of these links will be included down in the description for you guys below. But coming in at number 5, it is the ETF QUEB. This is the Crane Shares China Internet ETF. Now, you may look at the performance of this fund and say, you're crazy, man. Why would I invest in an ETF that's going down like this? Well, keep in mind, guys, midway through 2018, almost exactly when we saw this ETF start to drop, the trade war sparked off. We saw a pretty hard sell-off of the entire Chinese market, and as we'll look at in a second, a lot of the major components of this ETF are down big double digits. However, if and when we see this trade war ease up, this fund is holding some of the most powerful internet companies in China. Taking a look at the information for this fund, the ticker that we're looking at here is KWEB. It trades on the New York Stock Exchange. So although you're investing in Chinese companies, this is a US-based or a US-traded ETF. And for any of my Canadian viewers watching this, we are going to be doing a mix of both US and Canadian ETFs in this video. We can see by looking at the net assets that there are over $1.5 billion invested in this fund. If you opt to go out and buy this fund, you're going to be adding to this big pile of money. We see here the MER of 0.70%. Now, I will just touch on this quickly. Is this an expensive fund? Arguably so, okay? 0.70% is not cheap for an ETF, and as we'll look at later in the video, we're going to be taking a look at some ETFs under 10 basis points. But you get what you pay for. As we scroll down here to take a look at the top 10 holdings in this fund, essentially what this fund is giving us is a broad basket of some of China's largest internet companies. And of course, we do have the option of going out and buying these stocks individually if we choose, but this is a fund for someone that's looking for the broad exposure to the Chinese market. And I will just point out and say right off the bat that this is a high-risk fund. Taking a look at some of these companies, these are companies in China, which is an emerging or a developing country. The majority of these companies are involved in the technology space, which is inherently riskier. But when you invest in a diversified basket like this, what that does is it does strip out some of the risk of placing your bets all on an individual stock or an individual security. So yeah, 0.70% for the MER is not cheap, but it can be well worth it if you're looking to add a diversified basket, trying to get some exposure over to China. The top position in the fund, currently representing 10% of this ETF, is the company Tencent Holdings. This is the company that commonly gets the comparison to the Facebook of China. They're also very big in the video game space. Next up, Alibaba, which I'm sure you're all familiar with. They have exposure to the company Baidu, which is essentially the Google of China, the big search engine over in Asia. Meituan is a big food delivery company headquartered in Beijing. They also have NetEase, the video game player, JD.com, the big e-commerce company, and then a handful of stocks representing about 4% or below of the entire fund. And keep in mind, guys, these are just the top 10 of 45 holdings. Now, before we move on, we'll take a look at the performance of this fund. Quickly, we see here the breakdown of this fund. About 60% of the fund is currently invested in tech. This is a Chinese tech fund. And then about a third of it, or 30%, invested in discretionary, and then a very minor weighting to industrials and financials. We also see here that the fund is primarily built up of large and mid-cap companies, which I think is a positive. And when we're already investing in a volatile market, it's nice to lean towards some of these more established, these bigger and built up companies. Taking a look at the performance since the fund's inception back in 2013, in other words here, if you had held this stock for the past 5 years, you'd be up about 60% on your position. Now that's cumulative, which is the equivalent to about 9% per year when you look at that on an average annual rate of return. At the end of the day, this is a fund that I believe would be suitable for a portion of your portfolio. I personally would never consider investing all of my money into a single ETF such as this. But like I said, if you are looking to get some Chinese exposure in your portfolio, but you don't necessarily want to go out and pick individual stocks, QEB could be a great option. And again, if the trade tensions ease up, which I think is a good possibility over the next year, I see a good runway for the ETF KWEB. Moving on to number 4, it is the ETF VDC, the Vanguard Consumer Staples ETF. And a very close comparable fund for any Canadians watching here would be the STPL, the BMO Consumer Staples Hedged to Canadian Dollar ETF. As we'll see in a second, they do have very similar holdings. But this is a fund that's actually almost the opposite of the one we just looked at. That was more of a niche, unique fund for a small portion of your portfolio. This fund, on the other hand, could be used for a significant core position in your portfolio. I love investing in the consumer staples sector just because of the predictability that it provides. We'll take a look at that in a second. But we will focus in on the Vanguard fund, taking a look at the key stats. Let's skip right on down and look at the holdings of this particular ETF. We're seeing names like Procter & Gamble, Coca-Cola, PepsiCo, Walmart, Philip Morris. They're the cigarette company that makes Marlboro smokes, Costco. These are some of the most well-known and established blue chip businesses in the world. And this is what I mean when I say that this could be a good fund for the core of your portfolio. Looking over to the left here, we see just how diversified this fund is. Exposure to the agriculture sector, drug and retail. We see one of the larger weightings is household products. These are things that people need to buy year-round, right? Toilet paper, laundry detergent. These are things that provide companies with very, very consistent and stable incomes and revenues, meaning that these companies can often pay out very reliable dividends. We also see exposure to supercenters, packaged foods, personal products, soft drinks, and tobacco. Now, what I love about this fund, as I scroll up here to the ETF facts, is that this is a fund that is extremely cheap at just 10 basis points, which states here that it is 92% lower than the average expense ratio of funds in a similar category or with similar holdings. Like I said, guys, this is the US version. The Canadian version does have a slightly higher MER at 35 basis points, but as we can see, guys, holdings very much in line, very, very similar. Now, with both of these funds, what I think is great about them is because they are invested in high dividend yielding sectors, these funds pay out very nice distributions. Now, distributions are essentially dividends paid out by the ETFs. What they do is they collect all the dividends flowing in from their holdings, and from time to time, they'll pay a distribution to the shareholders. Now, every fund is different, but as we can see here, distributions scheduled for this fund are scheduled quarterly, and this fund is currently yielding right around 2.7%. Scrolling down, we can see the performance of this fund has been very consistent. Its 10-year return has been just over 11.25%, and since its inception back in 2004, has averaged just shy of 9% rate of return. So that's it for this fund. Kind of a boring one, I know, being in the consumer staples sector, but with a lot of talk of recession on the horizon, consumer staples is a sector that typically fares well during these periods, hence why I believe it could be a good buy going into 2019. Number 3, it is a fixed income ETF, BLV, the Vanguard Long-Term Bond ETF. And if you haven't noticed already, I will be including a little timestamp down below this video in the case that you do want to skip over one of these sections. But fixed income ETFs, or holding bonds in your portfolio, I think is extremely important, especially the older and older you get. So we can quickly go over and touch on the important facts of this ETF. I will just mention that I know a lot of people don't like to hold bonds. They'll avoid investing in bonds in a rising rate environment. However, I do still think that they're very important, not only for the yield that they provide, but as well the protection that bonds give you, the protection that fixed income will give you in the case of a market crash. I'll also note here that although rates are expected to continue to rise, I suspect that we are going to be seeing a bit of a slowing, which is good for the fixed income market. But as we see right away by looking at this chart, this ETF yields a 4.03% yield, which is right around the range that we could expect when investing in bonds. But as we see here, guys, again, very low MER of 0.07%, 7 basis points, which is 91% lower than its peers. It has a risk tolerance or risk potential trade-off of 3, right smack dab in the middle. We can see here again the yield slightly different from the different sources you look at, but a yield here of 4.12% with an A credit rating. We'll scroll down here to show just what type of bonds this ETF is comprised of. And as you guys probably know, the lower and lower the credit ratings of these bonds, the higher yields we can expect. That's where you get into the junk bond or the high yield territory. But of course, what comes with that is a higher risk of default or not getting paid back for these bonds. So this mix, in my opinion, is very well balanced. It's a fund that I think many investors would be comfortable holding. It's got a quality mix. And we can see that here by over $10 billion of net assets in this fund. This is a pretty large fund. This ETF pays out distributions monthly, which is great if you're looking for income, and has averaged a return of 6.2% since its inception back in 2007. Let's move on to the next fund, guys. I know no one wants to sit here and hear me talk about bonds. Number 2, it's VPU, the Vanguard Utilities Index ETF. Now, again, another US fund here. Unfortunately, I'm personally not following a good Canadian comparison. If you know a good one and you're willing to share, please leave a comment down in the comment section below. But this fund, again, extremely low MER of 10 basis points. It's a fund that essentially focuses in and attempts to track the investment return of utility stocks. Now, very much like consumer staples, utility stocks are very useful to have in a portfolio because of the consistent revenue that they're pulling in. I don't care what's going on with the economy. I don't care what's going on with the presidents, this and that. People got to pay for electricity. They got to pay their hydro bills. So it's a very, very reliable industry to be invested in. And rather than going out and picking a handful of utility companies for yourself, with a 0.10% management fee, you can very easily play the field. And as we can see, guys, the current yield that you're pulling in on this ETF is 3.14%. This fund has been around since 2004 and has averaged a rate of return of 9.61%. And despite utilities being under pressure recently from rising interest rates, this fund has actually still managed to stay in positive territory over a 1-year period, which is great. Taking a look at the number of holdings in this fund, there are 71 companies with $4.3 billion in net assets. As we can see, the top 10 holdings in this fund account for half of the ETF. We're seeing some of the largest utility players included in this fund: NextEra Energy, Duke, Dominion, Southern Company. These are some of the largest and most well-known players in the utility space. Taking a look to the left, majority of the fund is invested in electric utilities. That's just how the benchmark is set, and it's tracking the benchmark. Minor exposure to gas, independent power, and water utilities, but the remainder of the fund, a good chunk, a significant chunk of it, at around 30%, is situated in multi-utilities. And again, guys, the reasoning behind why I think this is a good fund to buy in 2019 is that utilities do typically perform well during an economic slowdown. Now, I actually don't think that we're heading into a recession over the short term, but if the market does, we will see investors cycle their money into more of these reliable, predictable sectors, hence why I see potential with this ETF. It does pay out its distributions quarterly, but if you're looking to get some utility exposure, this can be a great option, like I said, at only 10 basis points per year. Moving on to the final ETF, the number 1 ETF to buy in 2019, it's the fund VGRO, ticker VGRO. Now, if you're not familiar with VGRO, I actually did a full-on review of the ETF back on my channel earlier this year. I will link that down in the description below if you're interested in checking that out. This is one of Vanguard's newer funds. It's actually a very interesting concept. It's essentially an all-in-one fund. So this ETF is actually built up of 7 other ETFs. It's like what we would call a fund of funds. So it's like a fully balanced portfolio already pre-balanced and preset for you. And this is an option for somebody out there that doesn't necessarily want to go out and buy multiple ETFs and pay multiple commissions every time they buy or sell. This option here is a one-stop shop answer for your problems. As you can see here, VGRO is the Vanguard Growth ETF portfolio, which is balanced to a preset 80-20 asset allocation. In other words, 80% of this fund is going to be invested in equities, 20% of this fund is going to be invested in fixed income. But they also have two other options. They have VBAL, more of a balanced fund with a 60-40 split, and then VCNS, their conservative option. So depending on your specific age, your specific risk tolerance, you would pick the fund that's most appropriate for you. But taking a look into VGRO, the management fee that we're looking at is at 0.22%, so slightly higher than some of the other basic index tracking ETFs, but still extremely reasonable. Vanguard Growth ETF portfolio seeks to provide long-term capital growth by investing in equity and fixed income securities. So like I said, it's a balanced portfolio with a combination of both stocks. Now, the inception date, as we'll look at here, guys, was just January of this year. So it's a very, very new fund, and we don't have any historical performance to look back on. But over the course of 2018, the fund has built up a net assets of nearly $500 million already. I will note that this is a Canadian traded ETF, right? You guys have been asking for more Canadian videos. Here it is. The number one stock or the number one ETF for this video is a Canadian one. Below, we do see a visual representation of the asset allocation, almost perfectly aligned with their preset 80-20 split. The number of holdings in this fund is a whopping 12,294 holdings with an average PE of 13. Which is amazing. Clearly a diversified fund, which is of course what we can expect when the fund is built up of 7 already established ETFs. We see here the underlying holdings. We see an ETF giving us exposure to the US total market. We see a Canadian all cap ETF. We have an ETF excluding North America. And then we have a variety of bonds ETFs down below, as well as some emerging markets exposure. By looking at the top 10 holdings, guys, we do see just a very nice balance of both Canadian and US holdings. Companies like Royal Bank, TD Bank, CNR, Microsoft, Apple, Amazon. Like I said, this is a fund that is already structured like a perfectly balanced portfolio. And in my opinion, this is such an amazing option if you're looking to just park your money away for the long term without much hassle. If you are interested in seeing more of an in-depth breakdown, check out the video that I did. I will be down in the description below, but this is one of my favorite options to recommend to investors out there. Thank you guys so much for watching my top 5 ETFs to buy in 2019. If you enjoyed the video, please do give it a thumbs up. It really does help support the channel. If you have any questions, leave them down below. And if you're not already subscribed, I post a video every Monday. Also, if you're looking for individual stocks to buy, you want to take a look at my personal portfolio, join our private membership group. It's that first link down in the description below. But as always, guys, I thank you for watching, and I'll see you in the next video.